3 ways to keep more profits and know when to sell. This is the audio version of the article 3 ways to keep more profits and know when to sell, found on optionsizzle.com. For some traders, knowing when to exit a profitable trade is a lot harder than finding a good trading candidate. After all, you're not only managing a position, but you're also managing your emotions. Unfortunately, there are no hard rules to follow. In most cases, it's situational. However, I'll try to share some of my thoughts that could probably help. When you're buying premium or playing for direction, you want to know how much you make on a winning trade compared to a losing trade. Some traders can actually end up being net profitable even if they win 30 to 40% of their overall trades. How? Well, their average winning trade is significantly larger than their average losing trade. Furthermore, it's important to have some statistics on your trading results. If you're a new trader, you need to record your performance. I touched on this in this other article, Why Style Drifting Can Kill Your Success and Bankroll, but would like to expand on it here more. So what should you record? Well, you should record how many trades you put on, daily, weekly, monthly, yearly. How many trades are winners, gross. How many traders are losers, gross. What are your fees? What are your net realized gains after those fees? And what are your net realized losses after fees? What is your winning percentage? And what is your win-loss ratio? You see, knowing how much you win and lose on average, along with your winning percentage, will give you a great insight on what kind of adjustments you'll need to make to become a profitable trader. In an earlier example, I mentioned there are traders who can get away with winning less because their win-size-loss ratio is high. On the flip side, there are traders who can win 55% of their trades and still end up being net losers. They either can't cover fees or their average losing trade is much greater than their average winning trade. For example, if your average winning trade is $1,000, but your average losing trade is $1,200, you won't make it if you win 54% of your trades. In this case, you've got to let your winners run more or tighten up your risk so that losers become smaller. With that said, it's important to recognize the type of trade you're in. For example, if you bought Netflix at the money calls ahead of earnings, you should be aware that volatility will get sucked out of the options. And if the stock price barely moves or sells off, those options will get killed or lose money. This is a high risk, potentially high reward trade. Knowing this, you should prepare for the worst, what you could potentially lose if you're wrong. I'd also put biotech stocks in the high risk, potentially high reward category. For more information on identifying these types of trades you're in, check out When to Stop Out of a Trade and Take a Loss on optionsizzle.com. Now, if you're using options to express a technical view on a stock, you might want to do some what-if analysis. Most brokerage platforms have position analyzers. For example, if you use Thinkorswim like me, you can play around with the analyzer. What will my options be worth if the stock reaches this level? What will my options be worth in a couple days if the stock stays flat? What will happen to my options if implied volatility comes in a couple points? By doing this type of what-if analysis, you'll have an idea of what your options will be worth under various scenarios. In addition, you'll have insight on how long the options can be held for until the time decay starts accelerating. The position analyzer is a great feature for those technical traders who want to know how various price levels will affect the value of an option under different volatility moves and time frames. What if you buy options based off unusual option activity? This one is a little bit trickier because you're following the smart money, but it's not your idea. Unlike trading an event or a technical pattern, you're not always sure why the smart money has gotten into the trade. In most cases, the option market is forward-looking and ahead of the news. The article, Was This $2 Million Options Trade Ethical?, found on optionsizzle.com, is a great example of this. That's why it's important to tap into your inner detective, which is covered in some detail in the article found on optionsizzle.com when to stop out of a trade and take a loss, and more in depth on our free report found on optionsizzle.com. Again, knowing what your average win rate, win size, loss size ratio, winning trade, and average losing trade can really help. You'll hear many professionals tell you to trade your position and not your P&L. Of course, this is easier said than done. For example, I know some traders who will get less aggressive on a trade they like if they are getting hurt in other positions. Or they might take profits a little too early to make sure they cover their losses in another trade. Is this the right way to trade? Probably not, but it will help you avoid large drawdowns. Piecing out. One method of taking profits is to scale out of a position. For example, let's say you buy 10 call options for $1 each. The options start moving up to $1.30. The trader sells 8 calls for $1.30. The trader makes $240 in profit. They are left with 2 options that initially cost $200. The trade guarantees a profit with 2 runners. The trader could hold the rest of the call options to see where they go. This is just an example. Different configurations could be used. Is this how you should trade? Again, hard to say. What if the stock really runs? If you hold all 10 of those calls, they would have given you incredible gains. Remember, options offer convex payouts. Unlike stocks, they don't move in a linear fashion. For example, on Monday, July 21st, 2014, Herbalife weekly July 25.50 puts opened at 25 cents a piece. When the stock was around $60 a share, the stock fell 11% and option volatility exploded after Bill Ackman announced that he would give a presentation on why the company is a fraud. Those $50 puts traded as high as $2.50. If you pieced out, you could have missed out on some nice gains. Is it smart to piece out? It could be. Again, it depends on your numbers and what your losing trades look like. If you're a responsible trader who doesn't take big losses, then piecing out or scaling out will work. In fact, it's a technique I use very often. Of course, there will be times when you piece out and a stock really moves, probably wanting to kick yourself for not holding the full position. But that's trading. Successful investors and traders I know and have met know that it's about longevity, not getting greedy, taking a little bit out of the market and stacking your chips. After all, no one can really pick tops or bottoms, and the stock market can be very random at times. Sure, Lady Luck could be on your side when the stock's in your direction when you fully sized up, capturing massive gains. But when you're buying options and playing direction, when you get that move, it makes sense to sell into it. Remember, when you're buying options, you're not only playing direction, but you're also long option volatility, and it's a race against time. In addition, you've got to take into account the opportunity cost. For example, money allocated in one position means less money available for another. Having dry powder for the next opportunity is never a bad idea. For me, the decision's easy. I sell into strength. If I miss a bigger move with less positions on, so be it. I know my numbers and what I've got to do to be successful. On to the next trade. I bring this up because last month some members of the Option Sizzle community followed very large unusual call buyers in the September 50 calls in Twitter on June 12th. The large buyers paid between 80 and 90 cents on over 60,000 contracts. Within 3 weeks, those options more than doubled. Some are still holding, and at the time of recording this, those options are trading around 47 cents. If they pieced out, they would have taken their profits and had capital free for the next opportunity. Not saying that this trade doesn't have a chance to still work, but you've always got to look at your opportunity cost. And for those Herbalife put buyers, if they held those options on Tuesday, they would have seen the stock rise over 25% and the option volatility get crushed. It's examples like this, which happen way too often, why I piece out of my trades. Now here are some advanced alternatives to taking profits. Always keep in mind that costs associated with trading are bid-ask spread and commissions. Rolling. Another way one could take profits is rolling out your position. For example, let's say you bought 10 of those weekly 50 puts in Netflix for $1 and sold them at $2. Now, you take your $1,000 in profits and buy another strike or contract month. This gives you a chance to still gain while only risking profits. You might want to roll your position to reduce the size of your premium exposure. In addition, you could do it to increase your leverage while reducing risk. For example, let's assume the trader still felt that Herbalife had more room to go down. They could have taken their profits and bought 13 725.44 puts for 70 cents. In this example, they would have more leverage with 13 contracts but less risk. Is this a viable alternative? Possibly, but I wouldn't do it with this stock. Why? Because Herbalife options are tough to trade. If you don't know what I mean, just read the article, What Are the Best Stocks to Trade Weekly Options, found on optionsizzle.com. In it, I go over my criteria of finding good options that are tradable. Spreading. If you're in a long-term option trade that profits, spreading might make sense. For example, let's say you bought an at-the-money option that are 200 days till expiration. The calls you bought doubled from going $2 to $4. However, you still like the trade, but don't feel comfortable with having that much premium concentrated in the position. You might look to sell some further out of the money options to collect a dollar premium. This reduces your overall exposure while keeping your trade in play. You could also do this with near-term options if the implied volatility is high enough. Hedging. Another way to keep the trade alive is by hedging. For example, you bought bullish calls and still believe in the trade. You might want to look at buying puts to hedge against an adverse move. Keep in mind, you may be adding to the risk. For example, if the stock trades sideways, the time decay will come out of those calls and also puts. Furthermore, it's best to do what-if analysis if you want to go this route. After plotting the trade in your position risk analyzer, you'll know if it makes sense or not. What should you do? As you can see, there are several approaches to taking profits. To be honest, we know the best answer after the fact. Oh, if I just held those options, I'd be up X amount of dollars now. I should have sold here, but now it's too late. I sold way too early. Again, if we knew the perfect time when to sell our winners, trading would be easy. There are no hard rules. The best thing you can do is familiarize yourself with your trading performance. Identify the type of trade you're in and do some what-if analysis. Piecing out, rolling, spreading, and hedging are all viable methods worth exploring, but the right answer or technique is always found after the fact. Well, what about getting out of short premium trades? Well, I'll be covering that for you in our next article. What I will say, though, is that it's a completely different approach than taking profits on long premium positions. In fact, I think it's a lot easier to understand in my opinion. By the way, which one of these 3 techniques will you start using first to take profits on winning trades?